Chinese Communist Party is cracking down on Chinese companies, and the Chinese economy looks more and more unstable. So why is Wall Street forcing people to invest in China? Welcome to China Uncensored. I'm Chris Chappell. Earlier this year, the Chinese Communist Party started a crackdown on some of China's biggest tech companies. That revolution cost investors more than $3 trillion. Then, Evergrande, one of China's largest real estate developers, started warning it could default on its debts. And now, even as it looks like Evergrande could collapse, some of China's other big property developers are saying they could default too. Now, as Wall Street looks at these giant neon warning signs, they've come to an important conclusion. It's time to triple your investment in China. That's according to BlackRock, the world's largest investment firm. But even if you don't want to invest in China, Wall Street may be forcing you to invest in China anyway. That's because China makes up a huge part of emerging market indexes that are used as a standard for the financial industry. Why is that happening? And is there a way to make sure your money doesn't fund authoritarian regimes like the Chinese Communist Party? At the Oslo Freedom Forum, Shelley Zhang sat down with Perth Tolle, the founder of Freedom 100 Emerging Markets Index, to learn more.
Perth, thanks for joining us.
Thanks for having me.
So let's start out with, what is an emerging markets index?
Yeah, so there's three classifications for stocks globally in general. There's developed market, emerging market, and frontier market. An emerging markets index captures the emerging market universe, which is typically 26 countries, and it's typically countries that you think of like China, Russia, Saudi Arabia, Turkey, etc. So there's a lot of autocracies within this universe, and most emerging markets indexes, which are market capitalization weighted, capture a lot of weight to the worst autocracies in the world, like China, Russia, and Saudi Arabia. So China has typically about 35 to 40% weight in most emerging markets indexes, and Saudi Arabia and Russia are also typically in the top 10 country holdings.
So for emerging markets indexes, when you say they're done by market capitalization, so China having one of the biggest markets and economies in the world, is that the most represented country in emerging markets indexes?
Yes, China is the biggest, most represented country in most emerging markets indexes, or I should say all emerging markets indexes, specifically ex-China indexes and ours, because it's freedom weighted.
Like, what does it do when so many indexes are so heavily weighted towards China? Like, what does that do to the investment community?
Yeah, so indexes provide the benchmarks for the investment community to follow. MSCI being the biggest indexer in the world, probably around 90% of the world's institutions and biggest investors have to benchmark to MSCI by policy. So if MSCI's emerging markets index has 40% China, then they have to follow that weight, whether they're using an index or whether they're actively managing. They're going to have to follow that benchmark if they don't want to have what's called tracking error, which bet against the benchmark, and you have high tracking error, which means it differs from the benchmark in the variation in the returns, then you could, potentially be held responsible for underperformance. So you don't want to underperform the benchmark in any way for job security and other reasons in the investment world. So most investment professionals, especially the largest institutions, are going to have to track the benchmarks, and MSCI is the biggest one out there. FTSE is probably the second best.
So these funds, they're just going to do whatever the index provider says.
Pretty much. When it comes to benchmarking and following, tracking the benchmark without tracking error, that's what most people are going to do, and they're not going to deviate more than half or 1% from that typically.
That is not a lot.
Yeah, and typically, and even in ESG products, right? ESG products, the biggest emerging markets ESG funds in the United States have in their investment briefs that they can't deviate more than 1%.
So ESG is like sustainable investing. Like what is that?
Yeah, environmental, social, and governance. So it's kind of the new socially conscious investing buzzword. Not really new. It's been around for several years now, but in the case of emerging markets, it makes very little sense because it's still following that parent index, which has more than 50% in autocracies. So the benchmarking to the parent index is a kind of a industry standard and also kind of a big problem if you're trying to avoid autocracies.
So you're a socially conscious person. You want to do sustainable, socially conscious investing, but you're still putting 40% of your money in China. Yeah. There's no way around that.
So if you are a ESG investor and you say, okay, I want all my investments to be ESG, my entire allocation, including emerging markets, and you put your emerging markets allocation in let's say the biggest emerging markets ESG ETF in the United States, yeah, when the parent index has 40% in China, you're going to have 40% in China.
So what kind of institutions are investing in these like index funds, emerging markets index funds?
So pretty much every institution, large public pension, even if they're not investing directly in index funds, they're tracking them themselves. So through direct indexing or SMAs, and they're following that benchmark. So they're following what's in the index, whether or not they're directly purchasing an index fund.
Okay, so indexes seem to have an incredible power then in the investment community.
Absolutely, they are the standard bearers for the industry.
What do they say about that? Like that their decisions are like affecting what everybody is forced to invest in, essentially.
Yeah, ironically, the biggest indexers or the heads of these firms have come out and said, well, we don't tell people how to invest. When confronted with why do you have still so much investment in China, why are you increasing your China exposure at this point, they're saying, well, we just follow the market capitalization. We don't tell people how to invest. But in fact, they are absolutely setting the standards for how everyone invests.
You're saying their justification is they follow market capitalization. There's that kind of always been that like logic about, oh, we have to invest in China because it is such a big economy. There's no way we can not invest in China. Like, is that kind of the rationale behind this?
That is. So when your whole investment thesis is based on market capitalization, the biggest companies in the world getting the biggest weights and therefore the biggest markets also getting the biggest weights driven by those country weights, then yeah, absolutely you have to invest in China because it's the second biggest market in the world. So when market capitalization is your weighting mechanism, you have no choice but to have a large China allocation.
If you're investing your money that's going into somehow one of these ETFs or funds, you're going to be invested in China no matter what. You cannot not invest in China.
Correct.
That is stunning, given exactly what's been happening with China in the last few months, right?
Yeah, absolutely.
Like with, Chinese companies, failing like Luckin Coffee, with Chinese companies like Evergrande, possibly bringing the entire real estate market to the brink of collapse in China. MSCI, FTSE, these indexes are still saying, well, like our hands are tied.
Yes. So MSCI CEO has come out and said, we don't tell people how to invest. And iShares, which is BlackRock, which tracks MSCI indices, they have come out and spoken very favorably toward China and also have now told investors to triple their China exposure. So they're saying at this time, after all of this has happened in China recently in their market, after destruction of capital has happened on the biggest scale we've seen in recent years, you should now triple your China exposure. So these are firms that I think right now we're realizing that they're trying to get licenses to operate in China. It's very difficult for Wall Street firms to turn down access to the Chinese market. So they're, just as in the US, when the boomers were first retiring, that was a huge deal for the financial services industry. Same thing. Right now in China, they're seeing that same potential because it's a huge aging population. So everybody wants to operate there. I think JP Morgan is applying as well. BlackRock is definitely there. Blackstone in the private equity world, Bridgewater operates there, or so it seems, in the hedge fund world. So there's a lot of Wall Street people and investment people that are operating in China. And it's a very difficult market for them to turn down access to. And of course, China doesn't just give access to everybody, and it's not a fair and open market, right? It's not that you compete for access with, providing the best value to your clients. No, it's the government gives it to you. So they have to say what the government likes to hear if they're trying to get access to that market.
Now, one thing that I found fascinating was there was a recent Wall Street Journal article that came out and basically talked about the returns on MSCI's China index. You know what I'm talking about, right?
Yes.
So over the last 30 years or so, they've gotten 2.2% return a year.
So this is the Jason Zweig article, The Thorny Problem of Investing in China. Great article. And yeah, it pointed out that MCHI index, which is China, MSCI's China index, which encompasses all kinds of China shares. So it's a good benchmark. Has returned about 2.2% per year since 1992. And this is during a time when China really opened up and they made strides in their economic freedoms. So that slight increase in economic freedoms from abysmal policies under Mao, where millions of people died in famine, to these not so bad policies created this huge growth in the country where people lifted themselves up out of poverty because they were given the freedom to do so economically. And this was a time during which that happened. And China's GDP, as we've seen in the last 30 or 40 years, has grown tremendously. And this growth is real. But the stock market investors did not capture that growth because in an unfree market, that growth does not go to shareholders. It goes to benefit other stakeholders like the state. Or whoever the state wants it to benefit. There's a very murky ownership structure. So you don't actually know who's benefiting. There's very murky accounting standards, as we've seen with Evergrande. So you don't know actually what's going on. So just because a market grows a lot in GDP or in the economy doesn't mean foreign stockholders will be able to capture that growth.
And the crazy thing about this is the article compared the China index growth to if you had invested in the S&P 500 over the same amount of time, and there was like over 10% annual return for the S&P. So like if people had invested in the US stock market instead of the Chinese stock market, you would have had 5 times as big of a return.
And they're comparing to the US, which I think is a little unfair because it is a developed market, right? So emerging market is a separate category. But even if you compare it to like Taiwan or South Korea, neighboring markets to China, right? Taiwan has more than quadrupled that in the last 10 years. And South Korea has just about doubled it in the last 10 years. So that article is talking about a 40-year time span. I'm talking about the last 10 years. So there's other markets in the emerging market space that have better growth potential, that do have shareholder rights, that have economic freedoms and personal freedoms, and allow people to capture the growth that in their companies. Whereas in China and other unfree markets, as we've seen, we have not, as foreign investors, been allowed to capture that growth.
And what is crazy about this is like when you're talking about the market capitalization logic that like we have to invest this much in China because they're such a growing economy, and yet if you actually look at the return in the China index, you're seeing they didn't really get that good of a return. So
it was abysmal. It was worse than treasuries.
So like is there a disconnect there, or do people just ignore that part? What's happening?
I think a lot of times on Wall Street, and this is just conjecture, but a lot of times on Wall Street, product developers create products for themselves rather than for what makes sense for the client. I think ESG was an exception to that, where they're responding to client wants, but still didn't turn out that well because there's a lot of greenwashing. But market capitalization, the reason why I think, or one reason why I think it's so popular or so standardized, is because it creates a way to invest in the most tradable companies. So you want liquidity, you want tradability when you're creating products, so that people can execute and get good pricing. But you can't sacrifice that for, that can't be the only reason to invest, and that can't be your only criteria. So I think it's a good criteria to capture, a market as a whole, but it can't be your only one, because in an unfree market, you're ignoring risks that, like we're seeing in China now, of huge capital destruction, a lack of transparency, a lot of corruption, and these things that make a difference in emerging markets investing, and is the reason why a lot of people don't do emerging markets investing. So, we think that it makes more sense to, freedom weight, for example, like what we do. But yeah, market capitalization weighting can't be the only way to invest, and I think investors are starting to realize that.
Okay, so let's talk about freedom weighting. Your emerging markets index, the Freedom 100, does not have China in it at all.
Correct. It has no China because we're freedom weighted. We give the freer countries in the emerging market space a higher weight, the less free countries a lower weight, and the worst offenders as far as human rights and economic freedoms are excluded altogether. And so we get our data from third-party think tanks. Cato Fraser compile the data from 76 different variables encompassing the rights to, life, liberty, and property, or civil, political, and economic, or some people call it social, political, and economic freedoms. So all of those freedoms add up together for a composite score, and we use that composite score to then derive our country weights and allocations. And our country weights are 100% freedom weighted.
So what is the logic behind freedom weighting? Is it just like a moral thing, like you want to invest in free countries, or what's that?
Part of it is that because I grew up in both China and the US, and I saw the difference that freedom made in my own life and in these two different markets. But also, freer countries tend to grow more sustainably. Evergrande is the perfect example. It's not sustainable growth when all your growth is debt-driven and state-sanctioned, and that just can't last forever. So freer markets tend to recover faster because they are more flexible to respond to market trends and whatever the market needs, instead of what the government tells them to produce. And you see a lot less capital flight and capital destruction. For example, the one-child policy in China, that has caused 30 million missing women now in China. And that's 30 million men who can't find wives, and millions more in generations lost. That's capital destruction on a huge scale. And recently you've seen with their markets, huge capital destruction as well, with the edutech companies, with Evergrande, with Jack Ma, with Alibaba, Tencent. So all of these companies, you've seen the destruction of capital in. And these are companies that Americans invested in, companies that are the top 10 typically holdings in most emerging markets funds, or typically half of the top 10 holdings in most emerging markets funds.
Yeah, what's interesting to me is that, people kind of think that like investing in China, the Communist Party is going to come in and save these companies that are too big to fail. But what you're pointing out essentially is that on a whim, they can also destroy entire industries. They can destroy the tech industry. They can take $2 trillion of loss, within a week. Like, this is like crazy.
And these are companies that are very well known, that, international investors are very heavily allocated to. So they are now showing that they're not concerned about the market at all, that their interests come first. And I think that's the key. When you're investing in unfree markets, the interests of the state always come first. And that's why there's a lack of freedom there, is because there are people in power that want to stay in power. So they don't want to give power or freedom to the people. They want to stay in power. And when you have that dynamic in markets, it's extremely toxic, because then firms are not free to act on their own or their investors or their customers' best interests or any other stakeholders. They're only what stakeholders that matters to the state. So you're always acting in the state's best interest. There's a cost to doing business like that. And when we're investing in those companies, we're subsidizing the cost of them doing business that way.
We're giving money to the Chinese Communist Party. And you've described this kind of broken investing system in the US, where companies, because of how the index funds weight China by market cap, and the funds have to follow the indexes, everybody's kind of forced to give money to the Chinese Communist Party.
We are directing capital to China most of the time unwittingly if we're investing in these index funds.
Is freedom weighting a way to solve this problem? Is that going to fix the industry?
This is actually why we created the freedom weighted index, because I want people to have a way to invest in emerging markets without directing capital to these autocracies against their own choice or even knowing about it. So when you're investing in a broad emerging markets fund, if you ask most people, they're not going to expect that they have 40% in any one country, whether it's China or any other country. It's a broad and diversified fund. So that kind of concentration risk, first of all, is just not healthy in a broad fund. And I think most advisors and institutional investors and professional investors know that, but individuals may not be aware that there's that much allocation to one country in a broad emerging markets fund.
I think people trust that, like, if you're putting your money in like a kind of like ETF fund or something that you're like, okay, well, this is more stable, right? Like, this is a stable place. This is a safe place to put.
Because of the diversification.
Yeah, but you're saying 40% in China is huge.
And you're exposed to that tail risk. When Luckin happened, and Alibaba, Tencent, and all these companies, the edutech companies, when all of these companies crashed somewhat due to government action and extreme government intrusion in China, it wasn't the China funds that were most exposed. It was these broad emerging markets funds because of the sheer size of these funds and the number of dollars in them. They were the ones that were most exposed to these companies and their crashes.
Do you think the industry can get out of this?
I think we can, yeah. I mean, I think the industry will respond to what investors want eventually. Right now, there are ex-China products out there, but that doesn't solve the problem of the other autocracies. So you knock China out of a market capitalization weighted index, doesn't really make much sense because it's the biggest market cap. So I think for me, freedom weighting is the way to go because it just makes more sense as far as, it gets to the root of the problem instead of the symptom. So China is not bad inherently. It's the system, the government there, causing not the lack of freedom that makes it an unfriendly place to invest, right? That exposes you to these tail risks. And also, there are the moral dilemmas, like everything that's gone on that you guys talk about.
So if people want to learn more about your index, where can they go?
We are at lifeandlibertyindexes.com.
Okay, thanks for joining us, Perth.
Yeah, thanks for having me.
Once again, you can find more information about the Freedom 100 Emerging Markets Index on lifeandlibertyindexes.com. And if you'd like to hear more from Perth Tolle, we did an interview with her on our podcast, China Unscripted, last year. I'll put the link below. I'm Chris Chappell. Thanks for watching China Uncensored.